Let's now see another important area, which is the taxation for the partnerships. So for the partnerships, basically CT divides them into categories: unincorporated and incorporated one. So unincorporated are the partnership in which two or more persons, national persons, join hand, okay, and enter into an arrangement for the business. But in this case, the entity itself is not being subject to the taxation. Okay, in this case, the unincorporated partnerships would be treated as transparent, which means that the partners will be taxed individually on their share of income which they will be earning from this unincorporated partnership. And for the incorporated one, it is a limited liability partnership entity in which the partners will not hold unlimited liability for the partnership obligations. Okay, and such entities would be subject to tax as any other the corporate entity. So in simple words, if you are entering into an unincorporated partnership, the individuals will be taxed in their own share of income individually, and for the incorporated one, it would be taxed as an entity. Now, the unincorporated partnerships are created normally without creating a separate legal entity. So we are just joining hand and starting a business. It could be a JV or any such thing. So in this case, the entity which is so-called entity of this unincorporated partnership will not have its own legal identity, and it's not considered separate entity from its owners. So you can simply say that any income which is earned by each individual partner will be taxed in their own hands, and the very important area is that each partner will have to be registering for CT purposes individually. Okay. Now, in this case, how it will be taxed? The partners as a whole, they can apply. So it is an election. They can they can opt for it that we are applying to FTA to become a tax that FTA should be taxing us as an entity. They can still apply to FTA if it is approved. In that case, such unincorporated partnership will also be taxed as a business, which means that the individuals will not be taxed if they apply to FTA and if their application is approved. But if they don't apply, so as a default, all partners will be taxed individually. So which simply say that if the partnership has two partners and the income is, for example, 600,000 or let's say 800,000. So in this case, the income would be divided into two, 400 and each partner A and B would be registering in their own capacity to file their CT returns and pay the taxes individually. Now, how we do this calculation of the taxable income for individual partners is that the income, expenses, assets, liabilities are allocated in the distributive share in the unincorporated partnership. Now, it's very important to understand that it's not based on the share of their investment. It is based on the sharing of their profits. And once the income flows through from the entity to the partner, in that case, any expenditure which the partner has incurred in connection with conducting of the business activity of that unincorporated partnership, such partner can claim it as an admissible expense as and when he is filing his own individual CT return. And the interest expense also, which if a partner has taken a loan and he has used that fund for you can say in execution of the unincorporated partnership, in that case, if any interest is also being charged to him, then in that case the interest can also be claimed as an expense. Okay, so it is again an important area. So just say that, for example, if I have to start a business with somebody and I have taken a loan of 100,000 and I have invested such 100k into a business. So in that case, such 100k, if I am, if I'll be charged interest on that interest also I can, I can do it as, I can record it as an admissible expense. And the important thing is that such interest expense would not be having any cap on it. So as in future sessions we'll see that the interest expense is only admissible up to 30% of the EBITDA, but in this case FT up till now has not specified any cap on this. Next is about taxability of the family foundation. So family foundations are very common in in UAE, where the entire family forms a business, and such business is being run on behalf of those family foundation members. So in that case, the family foundation, once it is formed, it can apply to FTA, and we, the family foundation, should also be treated as unincorporated partnership, which means if their application is approved, in that case they will also be taxed as same as unincorporated partnership, which means again that the income of the family foundation would not be taxed as a whole. Okay, it would be shared among the members of the family foundation, and each one of them would file their CT return separately. But if they do not apply, or their application is unaccepted, then in that case they would be taxed as a foundation and it would be taxed as a single entity. There are few conditions also with that. That the family foundation should continue to meet the following condition to maintain the status of the family foundation itself, and it is formed solely for the benefit of identified or identifiable natural person, which means that it is acting on behalf of individuals, okay, or for the benefit of a public benefit entity, okay, which could be a trust also. And the principal activity of such family foundation is only to receive, hold or invest the assets or funds associated with that investment. And the family foundation in itself does not conduct a business activity on its own. If it is so, it will be losing the status of the family foundation. And the main purpose of forming this family foundation should not be to avoid the CT, because if 3 people join hand and probably each one of them are getting 300k of income from the family foundation in their individual capacity, such income would not be taxed because it is below the threshold of 375k. So if the sole aim is only to save the tax, okay, it won't be treated as an unincorporated partnership, and of course it would be taxed on its income as a regular entity, which in this case would be 900k, and first 375k would be at 0 rate and the balance would be at 9% itself. I hope that these important areas are also clear by now.